Hi, Dave.
How are you?
Welcome. I'm great. Welcome back to everybody in the room and online. Dave, you describe yourself as a very macro-aware portfolio manager, and I think I'd like to kick off this conversation just by hearing the world according to Dave Way.
Sure. Well, thanks everyone for coming. It's always a privilege to talk to clients, and I do try to be macro aware. And really, for me, what that means is that you have to understand the environment. Like, we go out to meet companies every day. We're meeting, I had 3 company meetings this morning. And in order to get the context for doing that bottom-up investing, you just have to figure out like what house or what playground you're operating in. And so the way that I think about it is that there are 5 big pillars to the market, like what's happening with consumers, what's happening in the industrial economy, what's happening in energy, technology, and the financial world. And these are sort of like the pillars that sort of make up how I spend my time. But I think in some ways the more important forces are what's sort of happening under the surface. Because these pillars exist on the big tectonic plates of things like fiscal spending and tax cuts, the big geopolitical change that we're seeing today. And if you can understand how those shifting plates are impacting industries, it really helps you understand the context of individual companies, and then ultimately having those building blocks of individual companies that come together to build the most important thing, which is a portfolio, which in my case is trying to build strong equity returns with a very attractive volatility profile that keeps people invested through these difficult times. And there's always difficult times, there's always headlines, there's always change. But I think if I could leave anybody with a message today, and hopefully we'll get into it, is that the rate of change is really accelerating, and it's really important to have a clear view of what's happening now, and most importantly, thinking about a year from now, what are going to be the dominant themes that seem obvious in hindsight that should inform how we build and manage our portfolios today.
So you are the portfolio manager of the Long Short Alternative Fund, also one of the underlying portfolio managers in the Multi-Alt Equity Fund, and then we also have the Multi-Alt Balance coming out in a few weeks. Let's talk about how the Long Short Alt Fund is. Talk to us about sort of the flexibility that you have within the mandate first, and then how is the portfolio set up today?
The fund is really designed to bring 2 portfolios together. The long portfolio, which consists of about 50 stocks, higher conviction, and higher position sizes, so 2.5% average position sizes, and really complemented by a short portfolio that is designed to do a few things. The first is to generate alpha from finding companies that are viewed as good today and bad tomorrow, as well as hedging out some risks that might have me excited in some ways in a long opportunity, but there's sort of a risk that is really hard to mitigate, so I can short out a stock that will manage that risk. And moreover, in periods where the market is volatile and kind of going sideways, you can have an opportunity to own a portfolio that's not just trying to capture market returns, but also trying to capture the spread between the long portfolio doing well and the short portfolio doing less well.
So when we think about positioning right now, top 3 sectors are financials, materials, and tech. So I'd like to explore those in a little bit more detail. Let's kick things off with financials. Sort of Go Canada has been a big theme of the conference so far this morning. You've got TD in your top 10, you've got RBC in your top 10. Financials were great contributors to performance last year. Tell us a little bit more about the financial space, whether it's here in Canada or here in the US.
Well, the interesting thing about the Canadian financials, and so for me, I had gone many years and I didn't own a Canadian bank. And when opportunity presents itself, you have to be prepared to change your mind. And what I was really looking for was something really misunderstood about these very large banks. And if you roll the clock back a year, I think one of my bigger short positions was TD. And I was short the company. I have 3 buckets of shorts, like classic financial shorts, sort of ESG detractors, or like companies where there's some problems with governance or otherwise, and hedges for long. And TD was a really great stock within the ESG detractors. There was a well-known anti-money laundering investigation going on. It's funny, when I was at Wharton, I was actually a TD customer at Commerce Bank, and so I was aware actually of some of the issues that Commerce Bank had. and you kind of have to go back 20 years to understand them. But it was really just my position that Canadian investors were underestimating the risk, not just to the business, but also to how the company would be perceived in capital markets. And the simple thing that I was hoping for in the thesis was that A, there would be a large settlement, and B, people would grow concerned that TD would sort of end up like Wells Fargo, which was a company that had similar problems and then went through 5 years of growth and of no growth and meaningful underperformance versus peers. And it's kind of what happened. There was a big settlement. TD came out and said, we're going to spend a bunch of money. We're going to have no growth in the US. Things are going to be really bad. And it was really U.S. short sellers really pounced on it, and the stock meaningfully declined, meaningfully underperformed peers. But that's where you sort of marry what you expect to happen in the market with an understanding of how the business actually works. And so TD management, quite smartly, came out initially and said this was going to be a big issue. But TD sort of had a silver bullet that people weren't thinking about, which is they have a large Canadian business where they could reallocate their capital and very likely generate a much more positive outcome than what people were using to price TD. It actually went from short to very rapidly my biggest long, and it was a very successful trade.
Has that happened often in the portfolio or before, where you've had a short position that's then moved to the long book?
Well, I talked about how change is accelerating, and so there's actually a second stock that was in my top 10 that was the same thing. So I was short Caterpillar, big yellow trucks, and they had gone through a period of COVID where there was a lot of demand, manufacturing was difficult, they raised their prices 50%, and it was my perspective that demand would be meaningfully constrained and that their earnings would decline much more than the market expected. And so I was short the stock on that thesis, and it played out. They had meaningful negative earnings revisions, stock underperformed, and then we had the tariff news last April, the stock declined further, and that's when, working with our industrials analyst, I was talking with her about, like, is this market turmoil pushing the stock below where it should trade given fundamentals? And so I took a long position in Caterpillar. I went from short to long, and there was both the thesis that the core business would improve, and then on the side there was this interesting development where they were selling some of their big engines to this new demand area called data centers. And so they were actually in the process of expanding production. And when I tried to talk to people about what that opportunity was, people didn't really have a good way of putting numbers around it. But I knew it was exciting, I knew it was going to deliver growth, and I knew it would beat expectations. And our analyst, Shriji, who is based in London, she actually visited this facility and tried to help me size what the opportunity could be. And like, for a big, stable industrial company, it almost tripled off the bottom. So I think change is pretty constant, the market is volatile, and you can either choose to use that as a reason to be cautious and to stay away from these opportunities, or you can try to have a level head, understand what's clearly happening, and then take action. When the market gives you a stock at a 20, 30% discount, to have the courage to buy.
I think these stories really speak to just the flexibility that you have in your portfolio. Like, you can do things that the average investor doesn't have the capability to do. And those are good examples of that.
Yeah, and I think along the way, one of the things that I did was I was short John Deere, which was in a similar environment, but one of their key end markets, like the US farmer, has been in a multi-year recession. And so while there was tariff noise that was causing people to sell or short Caterpillar, I had the ability to go long a very fundamental and constructive thesis, and I could short out the risk that tariffs wouldn't end up as positively or less negatively as I was thinking. So you have the chance to go in size early into these exciting opportunities, and a long-only manager might struggle to do that because there are these very real risks, whereas I can hedge those risks away and really focus on the opportunity.
I want to talk about your second largest sector in the portfolio, materials. If I had $1 for every time I've heard the word oil prices in the last little while, we're pretty rich. But there's not a lot of conversations that are happening about the other things that flow through the strait or are not flowing through the strait right now. And so, are you thinking about those areas of the market, and is that somewhere that there's potential opportunity?
Yeah, absolutely. So energy obviously is the focal point. Interestingly, there was a ship that tried to kind of move through the blockade early on. I think that it was called like Starry Night or something. And it wasn't carrying oil, it was carrying methanol. And methanol is an industrial commodity. Iran is 10% of global production, and it's 30% of methanol that eventually floats on water to get to its end market. So there are very much smaller commodity markets that are also highly disrupted. And I used to cover chemicals 15 years ago, and I feel like every 3 years there's like a 6 to 12 month window where that experience comes in handy. Unlike covering banks or insurance where you're using that knowledge all the time, but to be able to see the opportunity and actually understand the companies and make a quick decision is really important. Russia's invasion of Ukraine was a similar example, taking advantage of that in nitrogen fertilizers and aluminum. And also being a short seller helps you pay attention to markets that are currently not doing well. I talked about the challenges with the US farmer. That was very bad for nitrogen fertilizer producers. And so I actually had to generate some alpha on the short side shorting nitrogen producers. But like the world changes and you change with it. So the advantage is you're kind of always paying attention. And when fundamentals go from bad to good, you're there. You're already there.
Darren actually mentioned that as well, talking about the deja vu of 15, 20 years ago as a research analyst, and just as you alluded to as well, where you spend so much time as an analyst getting a really in-depth knowledge of these individual sectors, and that then clearly pays off when you are running your own product or running your own portfolio.
When I talked earlier about the sort of tectonic changes, I think one of the things that people maybe are starting to think about, but has not really entered people's base thinking, is that the investment environment that really prevailed through the 2010s has changed. And so I think in the 2010s, what it favored was owning companies that were high quality, generated stable earnings growth, and you would benefit from both the earnings growth and the market increasingly appreciating these businesses. I was at an event and I met with the former CEO of the TSX. She was the CEO when it demutualized and went public, and I worked in corporate development there. And one of the things that we talked about was that whole era of demutualization, these companies going public. Like Visa used to trade at 10 times earnings, and over 15 years they grew earnings 8-fold, and the multiple went from 10 to 30. So these were great stocks when they were not expensive, but when a stock is 30 times earnings, you have to make big assumptions, A, about the future, and B, about how much people are willing to pay for a stock. And so I think having experience and a willingness to invest in parts of the market that are not viewed as high quality or capital light, I think is an important skill set that you actually didn't need and kind of got punished for if that's the approach you took over the last 15 years. But over the next 10 years, I think being able to invest in capital-intense industries is going to be a key strength.
Now, you're a lover of science fiction. And speaking of the future, you told me once that your love of science fiction helps you to understand the future or think about the future maybe a little bit differently. So I wanted to talk about AI and exposure that you have in the fund. So it's such a broad topic of conversation. How are you investing in AI right now? Where are you seeing the opportunities?
Yeah. I have a very unpopular opinion on the investment floor, which is that artists can predict the future much better than investors. And like scientists are all about making the future happen, and they can go through periods of excitement or not. But artists are very good at two things. One is envisioning how our human nature will interact with innovation. And number two, kind of what it means for the world we live in. And so the book I was mentioning, there's a Canadian artist, futurist. His name is Douglas Copeland. And in I think it was 2018, he wrote a book called Bit Rot. And it was about basically technology was going to melt our brains. People were going to get addicted to short form video. And people would probably end up working less. Technology would, it wasn't pessimistic, but it was just realistic about what the future would look like. And there was one chapter that really stuck with me where he visited Google DeepMind in, I think, 2016. Google bought DeepMind in 2014, which we could talk about as well. But he visited it, and at the time it was called machine learning, and he was very intrigued. So he fed the machine his old stories and asked it to produce a short story in his voice. So we all have that on our phones now, and it's obvious that we can do that. But at the time, it was about an artist interacting with what technology might be, and it's something that actually got me to keep paying attention to technology and understanding, what's the human's first impulse about how they're going to use technology. And I think there's a lot of excitement right now about what AI can do to augment our lives, but we actually tend to think about it, it's like, how do I spend my day and how can AI help? And I think in 5 to 10 years, there's going to be a lot more of, given what AI can do, how will we spend our lives? And so we're going to move from like augmentation to like sort of more invisible AI in our lives, and I think that's just very interesting. And the technologists can help us understand where the actual like machines that are going to help us do that are going, but it's really the artists who can paint the picture for you.
So you mentioned Google and DeepMind, so that's holding in your top 10. And Google, I mean, last year was really hit hard because the market thought that they really weren't keeping up with all the AI developments. And then, fast forward to today, that's seemingly not the case. So tell us a little bit more about why you like Google, and do you see that as emerging as one of the AI winners?
Well, it's interesting. So as someone who is like really attendant to risk in their investment process, it's not always easy to hang on to the winners of a major theme kind of all the way through the cycle. And so similar to NVIDIA, where I owned the stock, sold it, and then rebought it during the DeepSeek sort of crisis, I guess, Google was in a similar boat a year ago where it had this amazing business called search, and AI was going to take away the search business. And they were also behind the curve on technology because they kind of had their own technology, but there were all of these like hyperscalers going up, and this was viewed as a weakness, not a strength. And for me, the opportunity to invest in Google a year ago was that you could invest at a time where people had low expectations. Sentiment was poor. Google search was priced for failure, and it was a real risk. But if you did the fundamental bottom-up work, you could appreciate that the fact that they're 12 years into owning a frontier lab. Well, like Anthropic's 2 years old. I mean, it's amazing what they've been able to achieve, but Google has had deep research expertise forever, and they had their own infrastructure. And it was my view that even if search was meaningfully impacted, when you were buying it at like 14 times earnings, it was actually priced for failure. So anything better than failure would be success. And in the most recent quarter, Google search grew 19% year over year. It's actually growing faster than it was a year ago. And when I went to a big tech conference in September, like 4 months after I bought Google, all of a sudden Google was the company to model yourself after, to have the big infrastructure layer that models would be open to compete on all different platforms. And Google has become sort of the standard for what upstarts or new entrants are trying to grow up to and become. There's scientists who accidentally figure out how to make money, and they're amazing scientists. So it's a real success story for the company, but also picking your entry point right can really help you earn outsized returns and not be there when they go through these periods of turmoil where everybody expects perfection, and lo and behold, the world's not perfect for them.
I wanted to pivot to talk about your short book. You've been shorting now for close to 6 years. So what have you learned? It's a difficult thing to do, right? Like, what have you learned along the way?
So I've learned a couple things. I think the first thing is with the fullness, and you just heard from Brendan Sims, and he gives me a lot of data around how the short portfolio has contributed to the fund. And I think the first thing is I viewed myself as having a good skill set and a good temperament to being successful in shorting. As an analyst, I was very successful at finding sell and strong sell rated securities that would decline in value. But you don't know what your potential is until you're running a fund. And so I think the first thing that I learned is that I've actually been pretty successful at it. Both accessing the opportunity, and for the many periods where shorting becomes more of a high-risk, lower-return endeavor, that I've been able to navigate those periods without taking meaningful losses in the short portfolio. So it's really marrying the skill with the opportunistic nature of shorting to achieve success. And I think what I care the most about is that the short portfolio, delivers what I expect it to the overall portfolio. But I think the third and final thing I've learned is that it is really fun. Like, it's fun being right. It's fun sort of going against the crowd. It's fun to find things that people aren't paying attention to, but in 6 months, if 1 or 2, 3 things happen, that they will, and everyone will be like, how did you figure that out? Like, it's a great feeling, and I really enjoy it.
What would you say is a short that really represents your investment process that's worked out very well for the portfolio?
So a good short really requires 2 things. It requires a strong bottom-up company analysis and an understanding of investor behavior. So you need to be right about the economics of the business, and you need to be right about the timing where other investors will come around to your view. And one of the stocks that was like my biggest short for 2 years, and I covered it because the thesis played out and the stock got cut in half, was BCE. 11 years ago, I was meeting with the CEO, and I expressed concern about their free cash flow generation. I'm like, you're playing a game of raising your dividend against struggling free cash flow. You roll the clock forward a few years ago, we'd had like large immigration into Canada, which was good for the wireless companies. Like, the first thing you do when you get off a plane to a new country is you get a new SIM card and you get a new phone. And so it was really good for growth. And we reached a point where immigration was going to go the other way. And then all of a sudden, people started to look at the top line growth, which was like 1%, 2%. And I was like, it's going to go negative in the next year. And so that's when I shorted the stock. And as the growth went from 2 to 1 to 0 to -1, it wasn't a big change to like EBITDA and the dividend, which is what people looked at. But if you went down far enough, it like blew up their free cash flow. And all of a sudden, people, as they got worried about growth, and the stability of the dividend, they started looking further and further down and saw what I had seen for 10 years, which was that it was broken and they were going to have to cut the dividend. So when I can find a boring company where a very small change in the business leads to a very big change in the stock price, that's something that gets me very excited, because one of the risks in shorting is that you wake up in the morning and the company's been acquired at a big premium. Like, no one can buy BCE. So it was sort of like there was 0 upside and like 50% downside. And those are the situations where I get really excited. I can take it to a max short, and then I went from 60 to 30, and that's when I exited.
How do you sort of identify that inflection point where it goes from being safe to unsafe?
A lot of times, these situations evolve from people focusing on the sort of stability and the safety of a certain investment and ignoring things that might be further down in the financial statements that are going to be big. Like, one thing I learned about short selling is that I'm a bit of an accounting geek, so I would find all of these accounting shorts. You could think 2 years ago, people got really twisted up around the depreciation policies of like Amazon, Google, Microsoft, and I never participated in that because some of the other trends were bigger. And when it's smaller things like this, like, people don't care. So people tend not to do the work on the detailed stuff that I might do. So what you need to know is that the things that people are paying attention to will change negatively. And then when it changes negatively, that's when people widen their aperture, look at the total situation, and are like, oh no. And so I want to be short when people start saying, oh no.
Last few minutes, I wanted to touch on gold because that's been a big position in the portfolio over the last little while. It's obviously been a great contributor to performance. Tell us a little bit more about your outlook for gold right now and what's the thesis?
Every 50 years, it seems like some of the foundational pieces of geopolitics and like sort of the world financial order, every 50 years, those rules get rewritten. So the last time was in the 70s with Bretton Woods. And I think when I was talking about like the market, and there's like the 5 pillars of like the investing world and then the tectonic plates, like these underlying rules about how the financial world works, that plate is moving. It started moving in 2022 when Russia invaded Ukraine. One of the first things that happened was that all of Russia's assets in the West were seized. And so one of the sort of most important trading participants in the world is China. And so the thing that drew my attention to gold, which is a commodity I generally don't like, I don't like investing in. I think I adhere to the Warren Buffett argument, like you should be able to find something more exciting than a yellow rock to invest in. But it's something that we all agree is an asset that can retain value during periods of geopolitical turmoil. And the first place we saw gold start to move was actually in China. There all of a sudden became a very high demand for physical gold. Like gold was like $2,000 an ounce. And if you wanted to buy gold in Shanghai, you had to pay an extra almost $300 an ounce just to own gold in China versus New York, Singapore, Switzerland, whatever. And so that's where my interest in investment in gold started. And it's evolved to include a few different things, whether it's de-dollarization or potentially debasement of the dollar. I think one of the key issues facing the market that we haven't got to is what happens with inflation and what happens to rates. And so if the thing that we viewed as sort of the top of the pyramid safe investment, the US dollar, everybody's telling you that you probably shouldn't think that way for the next 5 years. And I think if you listen to Scott Bessent, if you listen to Howard Lutnick or people in the administration, there is an appetite to see a weaker dollar to improve manufacturing jobs in the US. Like it's all being done for reasons that have sort of economic sense, but gold is sort of the first asset to wake us all up to it. And it's actually the reason why I started buying energy last year, which was that as gold did really well and as base metals started to do well, as a former metals analyst, I did learn in previous cycles that as these hard commodities start to increase in value, you really want to have a good look at energy. And energy typically follows. Like I didn't expect a geopolitical conflict to really cause it to increase, but part of the reason why you'll be there is stuff like this happens. And I think that's what my fund's trying to do. It's try to make sure that investors are exposed to stuff that happens that's good and protect against things that happen that we can't quite figure out that are bad.
Dave, we have run out of time, so that was a wonderful conversation. Thank you for all of your insights. Everyone, that was Dave Way.
Thank you.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.